Hi, everyone, welcome to Commerce Earth YouTube channel. In today's video we will see fully about SIP, which is Systematic Investment Plan, and learn about its advantages and types. If you're new here, please don't forget to like, share, and subscribe to my channel. What is SIP, Systematic Investment Plan? A systematic investment plan, SIP, is a method of investing a fixed amount of money regularly, usually monthly, into a mutual fund instead of investing a large amount all at once. It helps investors build wealth gradually while reducing the risk of investing at the wrong time. Because the investment is made consistently regardless of market conditions, SIP benefits from something called rupee cost averaging. For example, imagine a person named Ananya who decides to invest 5,000 Indian rupees every month in a mutual fund. In January, the price (NAV) of the fund is 10 Indian rupees per unit, so she gets 500 units. In February, the price falls to 8 Indian rupees, so she gets more units, 625 units, for the same 5,000 Indian rupees. In March, the price rises to 12 Indian rupees, so she gets fewer units, about 416 units. In April, if the price becomes 9 Indian rupees, she again gets more units. This way, when prices are low, she automatically buys more units, and when prices are high, she buys fewer units. Over time, this balances her average purchase cost. After 4 months, she would have invested 20,000 Indian rupees in total and accumulated more than 2,000 units. Because she bought more units when prices were low, her average cost per unit becomes lower than the highest market price during that period. If later the fund performs well and its price increases, the total value of her investment may grow over time. SIP is popular because it encourages disciplined investing, does not require a large starting amount, reduces market timing risk, and allows money to grow through compounding over the long term. It is especially useful for goals like retirement, children's education, or buying a house. How does SIP works? Many investors believe that buying a mutual fund at a lower NAV, net asset value, is better than buying at a higher NAV. However, this is a misconception. NAV simply represents the per unit value of the mutual fund on a particular day. Whether a fund's NAV is 12 Indian rupees or 120 Indian rupees does not determine whether it is cheap or expensive. What really matters is the fund's performance and growth potential, not its starting NAV. For example, if you invest 12,000 Indian rupees in a fund with NAV 12 Indian rupees, you will receive 1,000 units. If you invest 12,000 Indian rupees in another fund with NAV 120 Indian rupees, you will receive 100 units. Although the number of units differs, the total investment value remains 12,000 Indian rupees in both cases. If both funds grow by 10%, your investment value increases by 10% regardless of how many units you hold. Therefore, having more units at a lower NAV does not automatically mean higher returns. In SIP investing, this concept becomes even clearer. When NAV is low, you get more units. When NAV is high, you get fewer units. Over time, this balances your purchase cost through rupee cost averaging. But choosing a fund solely because it has a low NAV is not a smart strategy. Investors should instead focus on the fund's historical performance, risk level, fund manager quality, and investment objective. A systematic investment plan, SIP, operates mainly on 2 fundamental concepts: the principle of compounding and the method of cost averaging. The first concept is compounding, which refers to the process where investment returns begin to generate their own returns. When you invest a fixed amount regularly, the earnings made over time are reinvested along with the original amount. As a result, future returns are calculated on a growing base. This creates a snowball effect, where the investment value increases at a faster rate over the long term. The longer the investment period, the more powerful the impact of compounding becomes. The second concept is cost averaging. Since SIP requires investing a fixed amount at regular intervals, the number of units purchased varies depending on market prices. When prices decline, the same investment amount buys more units. When prices rise, it buys fewer units. Over time, this spreads out the purchase cost and reduces the impact of short-term market fluctuations. This approach minimizes the risk of investing a large amount at an unfavorable time. Together, these two principles make SIP a structured and disciplined investment strategy that supports steady wealth creation over the long run. 6 advantages of investing through SIP. Long-term wealth creation through compounding. One of the biggest strengths of SIP is that it allows your investment to grow steadily over time. As your money earns returns, those returns are reinvested, which helps generate additional earnings. Over many years, this continuous growth can significantly increase your total investment value. Average purchase cost over time. Since SIP involves investing a fixed amount at regular intervals, the number of mutual fund units you receive changes based on market prices. When prices fall, you acquire more units, and when prices rise, you receive fewer units. This process spreads your investment across different market levels and balances the overall cost. Encourages financial discipline. By investing a fixed amount every month, SIP helps develop a consistent saving routine. The automatic deduction feature ensures that you invest regularly without forgetting or delaying your contributions. Easy to start and manage. You do not need a large amount of money to begin a SIP. Even small monthly contributions can be started, making it suitable for beginners and salaried individuals. Additionally, investors can modify or pause their SIP based on their financial situation. Minimizes emotional decision-making. Market fluctuations often lead investors to make impulsive decisions. SIP reduces this emotional stress because investments continue systematically, regardless of market ups and downs. Helps achieve financial goals. Whether planning for retirement, higher education, or purchasing a home, SIP supports goal-based investing. Regular contributions over time can build a substantial fund to meet future financial needs. Why should I invest in SIP? Investing in a systematic investment plan, SIP, is a smart way to gradually build financial security without needing a large lump sum. It allows you to invest small, fixed amounts at regular intervals, making it convenient and suitable for people with regular monthly income. Because the investment happens automatically, it removes the difficulty of deciding when and how much to invest. One strong reason to choose SIP is its ability to create long-term growth. As your invested money earns returns, those gains are reinvested, helping your total investment expand over time. SIP also helps manage market uncertainty. Since you invest consistently, your money is distributed across different market levels. This reduces the pressure of trying to predict market highs and lows and lowers the risk of investing everything at an unfavorable time. Another advantage is that SIP encourages consistent saving habits. Regular contributions build financial discipline and help you stay committed to your future goals. Over time, even modest monthly investments can grow into a meaningful fund. Overall, SIP is suitable for individuals who want a structured, low-stress, and goal-oriented investment approach. With patience and consistency, it can support major financial plans such as retirement, education funding, or purchasing property. How to get started with SIP investment. Starting a systematic investment plan, SIP, is simple and convenient. If you are using net banking, first log into your online banking account and navigate to the investment or mutual funds section. From there, choose the option to invest or purchase a mutual fund. You will then need to select the type of scheme you prefer, such as equity or debt, and enter the amount you wish to invest regularly. For mobile banking users, the process is similar. Open your banking application, go to the investment section, and select the mutual fund option. After choosing the scheme, confirm your SIP details and complete the transaction. If you are unsure about the process or need guidance, you can also visit your bank's nearest branch and seek assistance from a representative. For mobile banking users, the process is similar. Open your banking application, go to the investment section, and select the mutual fund option. After choosing the scheme, confirm your SIP details and complete the transaction. If you are unsure about the process or need guidance, you can also visit your bank's nearest branch and seek assistance from a representative. Types of SIP and related plans. Fixed SIP. Example. Rahul invests 5,000 Indian rupees every month in an equity mutual fund. Whether the market goes up or down, his investment amount remains 5,000 Indian rupees. This continues for 5 years without any change. Top-up SIP. Example. Sneha starts investing 4,000 Indian rupees per month. After 1 year, her salary increases, so she raises her SIP to 5,000 Indian rupees per month. The next year, she increases it to 6,000 Indian rupees. Flexible SIP. Example. Amit usually invests 6,000 Indian rupees per month. However, during a month when he has extra expenses, he reduces it to 3,000 Indian rupees. When he receives a bonus, he increases it to 10,000 Indian rupees. Perpetual SIP. Example. Priya starts a SIP without selecting a maturity date. It continues automatically even after 10 years until she manually cancels it. Trigger SIP. Example. Vikram sets a trigger that if the stock market falls by 5%, an additional 10,000 Indian rupees should be invested automatically. Systematic Withdrawal Plan, SWP. Example. After retirement, Mr. Sharma invests 10 Indian rupees lakhs in a mutual fund and withdraws 15,000 Indian rupees every month. Flexible SWP. Example. Mrs. Meena withdraws 20,000 Indian rupees normally, but during festival season she withdraws 40,000 Indian rupees. Systematic Transfer Plan, STP. Example. Rohan invests 2 Indian rupees lakhs in a debt fund and sets an STP to transfer 20,000 Indian rupees every month into an equity fund. Conclusion. SIP is a practical and structured way to invest in mutual funds. It promotes disciplined investing by encouraging regular contributions over time. By setting clear financial goals, deciding your investment horizon, choosing an appropriate amount, and seeking professional advice when necessary, you can work steadily toward achieving long-term financial stability and growth. That's it for today. If you liked the video, don't forget to subscribe and comment on my video, and don't forget to press the bell icon to never miss a notification.